Hello everyone, this is George Mashigan, E-mini Strategies. In this video, I'm going to discuss the specifics of the momentum strategy. Momentum strategy is a strategy that trades with the trend. It's a strategy that will give us signals in the direction of the overall trend. So it's a trending strategy. So step number one for that, the type of bars we're using to trade the strategy. Type of bars we use to trade the momentum strategy are either minute bars, time bars, or tick bars. The reason we're using time-based bars, right, minute bars or tick bars, is because by definition, a trend is when the market's moving higher or lower over a certain amount of time. Let's say if the market moves higher from 1400 to 1450 in 3 seconds, that would not be a trend. That's just a spike, right? So we need to see a trend. The market's moving higher over a certain amount of time or moving lower over a certain amount of time. That's why we do not want to use, we do want to use either minute-based bars, time-based bars, or either tick bars. Let's say 500 ticks, 5,000 ticks, or either Fibonacci ticks. That will be fine too. We use only 2-minute bar charts. So I'm going to show you 1-minute bar charts also, but all the results you see on our website are based on 2-minute bar charts. All right. Now, the indicators associated with the momentum strategy are indicator number one, something called momentum direction. Momentum direction is an indicator that has a value of either +1 or -1, nothing in between. When it has a value of +1, indicates we have an uptrend. When the value of momentum direction is -1, indicates downtrend. There's nothing between, so it's either uptrend or downtrend. So as you can see, it changes its mind all the time. So this indicator alone is really useless for us because it just has no any gray areas at all, right? So the second indicator comes into play, something called momentum strength. Momentum strength is an indicator that measures the strength of that trend. And the way we measure that is basically it oscillates around this black line that you see, which has a value of 2175. It's just an arbitrary number, all right? That oscillator, when it oscillates around it, so this indicator, when it oscillates above this 2175, it changes its color to blue, indicating strong trend. When it moves below that flat line, 2175, it changes its color to red, indicating weak trend. Right? So strong trend, weak trend, strong trend, weak trend, strong trend. It doesn't tell me the direction of the trend. It just tells me how strong the trend is. So the combination of these two indicators will tell me the direction and the strength of the trend. Therefore, if we have an uptrend, because the momentum direction says so, by being a 1 positive, right? And the direction of the trend is up, and the direction of the trend is strong, I meant to say, but the momentum strength telling me so, right? So with a strong uptrend, automatically the colors of the price bars get colored blue. So blue indicates strong uptrend. On the other hand, if we have a strong trend, by the momentum strength telling me it's a strong trend because it's moving up, it's above this horizontal line, but the direction of the trend is down, because momentum direction tells me the value is -1, therefore we have a strong downtrend, the bars automatically get colored red. So blue indicates strong uptrend, red bars indicates strong downtrend. Now, whenever this indicator is below 0 and the color is red, indicating weak trend, whenever we have a weak trend, regardless of the direction of the trend, either down or up, it does not matter. We have nothing but black bars. Black bars indicating weak trend. We do not pay attention to the direction of the trend at that moment. Now, whenever we have blue bars indicating strong uptrend, the strategy will only give us signals on the long side. Only buys, buys, and buys, right? Whenever the strategy is showing me that we have a strong downtrend, because we have red bars indicating strong downtrend, the strategy will only give us signals on the downside, sells and sells. Okay? Now, the third indicator, of course, at the bottom here, you could see something called momentum exit. Momentum exit is an indicator that, just like the name implies, only used for exiting trades and nothing else. So we do not pay attention to this indicator unless we are in a trade. And the way it's programmed, it's basically a histogram, as you can see. It oscillates around the zero line. When it moves above it, it becomes blue in color. When it moves below the zero line in negative, it becomes red, just so we can spot it fairly quickly. We do not pay attention to the value of this indicator. All we want to know is it positive or negative, and I'm going to show you exactly what I mean by that when I show you how the buy setups and the sell setups come into play. All right. To enter a long trade on the momentum strategy, step number one is, of course, we need to have blue bars. Whenever we have blue bars, we know we can only get long signals. So let's take one of these trades and expand the chart a little bit so we can go in details, see what makes the strategy produce or generate long signals and how we get these signals, how we exit these signals. All right, let's look at this one buy signal that we see that popped up on the chart. The way we enter a long trade is, as I said, step number one is blue bars. Blue bars is our first step. Number two, we need to have a setup bar. A setup bar is the bar that we see when the market moves lower and it closes below the trigger line. This green line that you see, that moving average type of a green line that you see, is what I call my trigger line. So when the market's blue, we know we have a strong uptrend, and the market moves lower and it closes below that trigger line right here. It closed there. The bar that it did the closing below the trigger line was what I call my setup bar. So this bar is my setup bar. Once I have a setup bar, I know I have a buy pending. I need a trigger for that. The trigger is the very next bar. If and when the very next bar trades one tick below the close of the setup bar. So as soon as the next bar trades one tick below the close of the setup bar, a buy signal will appear on the chart automatically. In this case, it says buy 2. I'm keeping track of 2 lots. It does not really matter. It could be buy 1 or buy 15. All right. So buy 2, it will automatically pop up on the screen along with 2 arrows, one horizontal telling me where the price is, and one vertical telling me which bar that signal is coming on. Again, mind you, this is not automated trading or mechanical system. It will not execute for you, but the strategy signals will appear automatically on the chart right away. So the setup bar is the bar that closed below the trigger line. So this bar has to close, but next bar has to trade one tick below that close. As soon as it trades there, a buy signal will appear in the chart. Now, once we are in a long trade, to exit that long trade, of course, we want the market to go higher, right? Intuitively, we want our exit indicator to go higher. We want it to go up all the way to crossing the zero line from negative to positive. So we want our exit indicator to change color and change its sign from negative to positive and cross the zero line. And as soon as it crosses zero line and the bar that does the crossover, which is right here, the bar that did the crossover is this bar right here, right? This is the bar that did crossover. That bar becomes my setup bar to exit that long trade. So the bar produces a signal that crossover from negative to positive is my setup bar. The trigger to exit that long trade is the next bar when and if the next bar trades one tick above the close of the setup bar. As soon as that happens, the exit signal will appear in the chart telling me to exit that long trade, and the trade is complete. Okay, let's move forward and we could see how we deal with a short trade. Here's another long trade that we see. This is the bar that closed below the trigger line, right? It closed below the trigger line and it became the setup bar. The trigger bar is the next bar when and if the next bar trades one tick below the close of the setup bar. Well, it did not. Therefore, we have no buy signal. It did not trade one tick below the close of the bar, which is the bar that closed below the trigger line, right? But it itself became a new setup bar because it closed below the trigger line itself. So next bar, soon as it trades one tick below the close of the setup bar, which is this bar right here, a buy signal popped up on the screen. And again, the exit comes in when the exit indicator moves from negative to positive, right? and that becomes your setup bar to exit that long trade, and the trigger is the next bar when the next bar trades one tick above that. That's on the long side. Let's move forward to see a short trade. Here's a short trade, and the way the short trade came about is basically waiting for the market to move higher. First of all, we have red bars. Red bars is indication that we can only get short signals on the momentum strategy. That's step number one. Step number two, we want the market to basically retrace in the opposite direction of the trend. So basically, red bars indicate strong downtrend. Now we want to have a retracement in the opposite direction, which it does right here. We want the market to go and close above the trigger line right here. The trigger line is the green line that we see, right? So as soon as the market moves and closes above the trigger line, that becomes my setup bar to enter a short trade. The trigger comes in when the next bar trades one tick above the close of the setup bar. Instead of trading below it, we want it to close above it. So as soon as the next bar trades one tick above the close of the setup bar, a short signal will appear on the chart telling me to enter a short trade. Of course, the exit comes in when the next bar exit comes in when we wait for the exit indicator to move from positive to negative and change the zero line basically. Let me move this a little bit higher so you can see this, right? We want our exit indicator to move lower. We want the market to go lower. We want our exit indicator to move lower to cross the zero line from positive to negative, which it did right here, right? So the bar that did the crossover, this is the bar that did the crossover from positive to negative. That became the setup bar to exit that short trade. The trigger is the next bar when and if the next bar trades one tick below the close of the setup bar. Let me move this a little bit lower, you can see this. So next bar has to trade one tick below the close of the setup bar. What it did not. Therefore, we have no exit. We need to wait for next exit signal. And what is the next exit signal? Well, of course, we want the exit indicator to move from positive to negative. One more time. Here it is. It changed direction again from positive to negative, right? That become my new setup bar right here. This is my new setup bar. That's the bar responsible for the exit indicator moving from positive to negative. So that becomes my new setup bar. The trigger, of course, is the next bar when and if the next bar trades one tick below the close of the setup bar. As soon as that happens, the exit signal will appear telling me to exit the trade, and the trade is complete. All right. What we did not talk about, of course, is when we took a long trade, right? When we're taking a long trade here and waiting for the exit signal to come in, how far are we risking? What's the most we are willing to risk in order for us to get out an exit indicator? As you can see, some of the trades will be losing trades. Some of the trades will be winning trades. Having said that, we still have to put stops in every single trade that we take in, right? In this case, for example, we had a short signal and the market went against us, but we got out. We did not get it stopped out. We got out based on the blue bars coming in and telling us we entered a long trade. So we had reversal. So it could be a losing trade or a winning trade, but every single trade has to have a stop. And where do we enter those stops? That's the most important part of the question. So the stops we enter on the momentum strategy are identical to the stops that we enter on the reversion strategy. To explain what kind of stops we're using on the momentum strategies, I want to go into my strategy result page, and we're going to be discussing the risk management settings. Again, if you watch my reversion strategy, you would understand this section is identical. But if you have not, please pay attention. This is the most important part of the strategy, and that is the risk management settings that we're going to be talking about. The risk management settings, here it says we have two different settings, an aggressive and balanced. The aggressive setting basically says we have $600 daily stop loss with no profit target per contract. Again, the operative word here is daily. That means the stops that we're saying is $600 total per day, per contract on a cumulative basis. So what are we saying? We're saying that at any given point in time, let's say we are long here and the market starts to move lower and we do not get the exit indicator to get us out. The stops that we're putting is based on the aggressive setting says that at any given point in time, if the strategy is losing $600 total on a cumulative basis per contract at any given point in time during the day, then the strategy will stop us out, gives a signal to tell us to get out that trade, number one. Number two, it will no longer give us signals for remaining of the day. So regardless of the signals that the indicator will give us, the strategy will no longer tells us to buy or to go short. So the setups that we have, this risk that we have, is based on total amount of money we're willing to risk per day, per contract on a cumulative basis. So once we reach that limit, that's it. No more signals for us remaining today, right? The second setting is something that's balanced. Again, it's a daily stop loss. In this case, instead of $600, we have $300 daily stop loss. However, we also have a second condition or condition, and that is $300 daily profit target, whichever comes in first. That means if the strategy generates a loss of $300 on a cumulative basis per contract, per day, at any given point in time, or it makes a profit of $300 per contract per day on a cumulative basis, then the strategy will stop trading. It will no longer give us signals for remaining of the day. Now, if I go down a little bit, first of all, let me explain this page real quickly. This page says the results are based trading 2 E-mini S&P contracts, commissions a fee of $5 included per contract. So results I'm going to show you right now, again, these are results of this, the strategy's results based on 2 E-mini S&P contracts, right, including $5 commission, and these are the monthly results. But before we do that, we see something here. It says market hours. We have 3 different market hours we're keeping track of: 24 hours a day, U.S. market hours, and European market hours. 24 market hours basically means this is the result of the strategy based on applying the strategy onto 24 hours a day, which is kind of impossible to do, right? Not many people will be able to trade 24 hours a day unless you have a partner or somebody's working for you, right? So these results that you see really are kind of difficult to achieve because they're really based on 24 hours a day. But the second settings that we have in the market hours is basically something that says U.S. market hours. And these are the results of the strategy being applied during U.S. cash market hours, namely 9 o'clock in the morning till 4 o'clock in the afternoon, right, Eastern time. These are results if you apply the strategy only during cash market, U.S. market hours. These are the results that the strategy is generating. Thirdly, of course, is something called European market hours. Now, European market hours are not we're not trading any European markets. We're still trading the ES. And again, the results are based on 2 contracts. However, we are trading the ES or the strategy being applied to the ES market only during European markets open, cash markets open, namely again from 3 o'clock in the morning to 11:30 in the morning, New York time, right? Here are the results for the strategy being applied to the European market hours. Overnight market basically for the in the U.S. session. Okay, now any of the strategies you can see 24 hours a day, U.S. market hours or European market hours with 2 different settings, risk settings. So we're looking at 6 different combination. These results that I'm showing you here, these are not results of any trades, any trades in any account. These are results of the strategies, signals as they're being applied onto real-time market data. So we apply the strategy onto real-time market data. Whatever the results are, these are results we're posting every single day. Therefore, they are to be called hypothetical results by law, by CFTC law. We have to call them hypothetical results because these are not results of any real trades. They're results of the signals as the strategy being generating when we apply them into the market. Again, mind you, real market hours, but again, these are not real trades. These are results of the strategy signals as they're being applied. All right. Any of these days that you see, of course, you can click on them and you can get the daily results, right? Now you can see, for example, in December, In 2012, we've reached the daily loss once on December 13th, right? Negative $1,200 because we're trading two E-mini S&P contracts, $600 a day, $600 per contract, right? We've reached it once. In November, if you click on November, you could see that we've reached it once, twice, right? And if we go back to September, which is 6,500, we can see the results, right? We've reached it basically one time on September 5th. So you get the idea. The results, you can go in there and look at the strategies results yourself and see what kind of results you get. Mind you, these results are the strategies signals as they're being generated, as I said, on a daily basis. But the only thing including here are the $5 commission per contract. We do not include slippage in here because slippage is definitely a fact of life. You will get some slippage sometimes. Because you'll get some signals that it's going to be at the bottom of the bar or top of the bar or what have you. So you may not be able to get the exact price or the market's moving too fast. You're going to miss some or you're going to have a power outage or whatever the case might be. You're not going to be able to get the slippage. You're not going to be able to get exact same prices as we're showing you. But nevertheless, I'm giving you an idea what the strategy has been doing throughout. Here's a chart, the daily chart for the E-mini S&P. We took the E-mini S&P daily chart and we applied the momentum strategy on it, okay, without any stops, of course, there because we're not using the daily, we're not using intraday here, so we have no stops in here. Just applying the momentum strategy, just to give you an idea how the strategy works if it's being applied on a daily bar chart. So daily E-mini S&P market. Each of these bars are 1 day. We're applying the momentum strategy on it and see what kind of results we get if we apply them on a daily bar charts. If we go, so we can go back and look at the strategy's performance. Going back to the inception of the E-mini S&P to 1997, these are applying the momentum strategy and a daily bar of the S&P market. Okay, this is a backtest report, basically, that we took the momentum strategy, applied it on the backtest of a daily bars to see what kind of results we get. Here are the results so far, as you can see. You know, so far in 2013, it's down. It's about 1 trade so far. Last year, 10 trades, 12,000. The year before, 11 trades, 13,000. 2010, not much happened. 2008, as you can see, when the market really trended, right? Both ways, mostly the downside, of course. 48,000, almost 49,000 on 16 trades. And you get the idea. Again, this is just to see what the strategy does when we apply them into longer-term bar charts, in this case, daily bar charts for the E-mini S&P. And of course, those results are based on trading 2 contracts, right? So the results you saw for the daily S&P are based on 2 contracts going back to 1997. Well, this has been a quick presentation on the strategy for the momentum strategy. I hope it was helpful. If you have any questions, please let us know. We'll be more than glad to give you help. Bye-bye now.